What's up, Gould Miners? Today, we welcome to the program Mark Willis. Mark is the owner of Lake Growth Financial Services, as well as a 3-time #1 best-selling author. And today, we discuss how people like me and you can take control of our money by becoming our own personal bank. Sound too good to be true? Well, not necessarily. Mark really breaks it down in this episode, beginning with exploring the bank on yourself concept. This concept was popularized by Pamela Yellen in 2008, and Mark is an expert in this arena and dives deep into how anyone can really become their own personal bank. Later on in the episode, we delve deep into life insurance. And I know what you're thinking. I know that I was thinking it too when I first started talking to Mark, is life insurance sounds kind of like a scam. And Mark does a really good job of debunking some of the myths surrounding life insurance and explaining how life insurance policies can be used effectively in a bank on yourself strategy. And finally, to conclude the episode, we touch on family banking systems and the strategies that families can use to eliminate depending on banks altogether. There are some fascinating concepts that we explore in this episode, and if nothing else, a way to broaden and expand your horizons. So whether you are brand new to the real estate investing space or you have been investing for a long time, there is definitely something in here for everyone. So without further ado, let's welcome to the show, Mark Willis.
The Gould Mine Podcast.
Mark, welcome to Gould Mine.
Glad to be here, Danny. Thanks so much.
Yeah, this is awesome, man. And you know, I think we just dive right into it. As someone who's listening to this, they just tuned on and they're like, hey, like, why should I listen to Mark Willis? So what does someone stand to gain from listening to you speak on banking on yourself, becoming your own bank, leveraging life insurance? Like, what is it? Why should they listen to you? And what do they stand to gain from listening to this episode?
Yeah, well, right there, if they haven't already unsubscribed, I hope they will keep listening. If they've been hearing anything so far, they're going to find that the strategies that we discuss here are as old as the pyramids, literally, if not older. And what we're going to discuss today, I think, will impact everyone's life if you interact with the financial economy in any way. So, I've had the great privilege of working with clients who are real estate investors, syndication managers, business investors, even NFL Super Bowl champions. But most people I work with, Danny, just want to have more agency. They tell me they want to have more agency, more control, more certainty over their finances. You know, many people, I think, just go through their life. The average American just goes through their life like maybe a tennis ball floating down the gutter of the economy. And when inflation hits, they just sort of like float, and they just get beat up by the current.
Oh,
and
man.
I love working with folks that want to swim upstream. They want to go against the current. They want to think not so average. I mean, that's the name of my podcast, Not Your Average Financial Podcast. I am a certified financial planner. But I'm not your average financial planner, because I'm not going to push people into the highest commissionable products like assets under management index funds or active trading or, whatever the latest and greatest meme stock is. I want to hear from you. What are we trying to accomplish, first of all? And second, I don't care what you call the asset that we're going to put to work, as long as it does what I want it to do for me, or in this case for you, right? Call my money a wet sponge, call it a 401k, call it life insurance, call it real estate. I don't care what you call it, as long as it acts the way I need it to act. So it helps me accomplish my goals without taking a bunch of unnecessary risk, which is where I think most people live their entire life in. That quadrant of unnecessary risk is something I want to stay out of. I'm big on risk. I'm a business owner. I'm a real estate investor. I'm not big on unnecessary risk. I'm not 18 years old anymore.
Yeah, that's it's interesting that I was just talking to someone else that we're talking about diversification. Well, I'm sure that we'll get there. Let's start where I think I had the most curiosity, just in terms of like knowing what you focus on, what you specialize on. This idea of becoming your own bank, right?
Yep.
First of all, in layman's terms, can you just explain? Like, so someone's like, "What does that mean?" Like becoming your own bank, like that. That sounds like, fugazi, right? Like this, right? So like, what is that? Like, what does that mean?
Yeah. Like, where's the lava lamp? Let's go into like grab some magic mushrooms or something and just really trip out. The idea that you could become your own source of financing is like saying it's anathema to most people. It's sort of like saying, hey, you could become your own nation or something. It just sounds like way out there. How could you become your own banker? This is a strategy that's been around for hundreds of years. And for many folks, it's the core of their financial universe. It has been for me and for thousands of our clients. And we've got an unbelievable opportunity in the real estate space. Because if you think about it, banking as a function is something that we have, in many cases, outsourced to somebody else. There's a lot of things I'm big on delegating. If you're a business owner, you got to. But if you delegate the wrong things, like your profit, to somebody else, that's a problem. You cannot delegate what's most essential. And for many business owners, and real estate investors included, delegating the banking function is like cutting your arm off to save a little bit of money on eating. It just won't work. Okay. It's not going to end well because, there's a thousands of year history on banking. There's a book out there. The title is the best part. I don't agree with all the conclusions of the book, but the title of the book is Debt, the First 5,000 Years by David Graeber. And what a book title, right? And it's a great tour de force of like where banking came from as a institution. Now we have sort of seen in our minds this idea of banks, like the credit unions and the mega corporation banks that we see on the street corner. But I'm trying to refocus that around the verb of banking. And the function or verb of banking can be done between you and me impromptu. Like I can loan you some money and you can pay me back or vice versa, right? Banking has existed before, Chase Bank or Bank of America or any of these mega, banksters, as I call them, were ever even conceived of. So the question is, how could you become your own source of financing? Could you lend yourself money and then pay yourself back? And what advantage would that be? Well, if we use the right tools, we can literally, in many ways, function like a bank. Not setting up an FDIC insured bank, right? But by using the right tools and asset classes, you can do all the functions of banking, recapturing interest. You might currently be shoveling out the door to your line of credit on your HELOC, to your mortgage company, to anything that coughs up money out of your pocket and puts it into the bank's pocket, credit cards, student loans, or any major purchase or investment you might decide to make, including major syndication investments.
Okay, so there's a lot to unpack there. Great. What are the first steps to doing that, to achieving, status as your own banker?
Yeah, so there's, I always talk about mindset, then skill set, then systems, right? So the mindset of being your own banker is a frame reset for a lot of people. I got to think different. If I'm going to think like a banker, if I'm going to do what banks do with their money, rather than doing what they tell me to do with my money, I got to think different. At the same time, I got to have actual logistical next steps. Like, what do I actually do, Mark? How do I function like a bank in the real universe of money market accounts and brokerage accounts and real estate and everything like the 401ks and more? The only place I can find as a certified financial planner, and I've investigated over 450 financial tools and products, and there are millions of ways to combine those hundreds of products together in a portfolio that just boggles the mind. But if you could just spend your time writing down what are the functions and characteristics of banks, what surprised me when I did my research here was that of all things, dividend paying whole life insurance, properly structured, will act and function like a bank or a line of credit to yourself day one, month one. So you dump money into this asset class and it acts as if you have your own source of financing for yourself. Let me explain how that works in detail. So, if this strategy makes sense and we have a one-on-one conversation, we've done a few advisory consultations. Again, as a fiduciary and CFP, I have to make sure it's in your best interest to do something like this. But let's say it's all working out and it looks like it's going to help you. What happens next? Well, we open up a policy. There's a few steps to doing that. Once that policy is open, you start pumping money into the policy. They call that premium. Now, most people think of whole life insurance as a big, expensive, commissionable product. Well, if we can cut the commissions, if we could cut the life insurance expenses and just make it function like a cash value machine, you can build a lot of wealth very quickly. So you dump some money in, You can do it one time. You can do it recurring. It's your call. But you dump some money in, and now you open up your account the next day, and there's an online cash value available. That means the money you can use while you're, breathing air. There's of course a death benefit. It is life insurance, but it's a lot more fun to spend money while I'm alive. Danny, I don't know about you. So borrowing that money, accessing that money can be done in various sorts of ways. One of the ways is through a policy loan. So let's use some numbers. Let's say you've got $300,000 in a cash value. All right. So that could be, the first month, or it could be the 10th year. Just depends on how much you've been funding the thing. But let's say you got $300,000 in that policy. That's liquid, accessible cash. Now you think for a minute, Danny, and I want everyone listening to think about this. What could you do with $300,000 liquid right now? How might that help your business? How might that help your real estate? When you access the cash value vis-a-vis a policy loan, the policy money comes into your bank account within about 4 or 5 business days. Let's say you found a really sweet investment, or possibly a hotel syndication deal or something like that. I don't know of anybody doing that. I don't know if you know of anybody, Danny, who might be offering such strategies. But let's say there's a really sweet deal. Yeah, you, right. So let's say that there's a really sweet syndication that we want to invest in. I borrow from my dividend paying whole life insurance policy. We'll call it a bank on yourself designed policy. I loan the money I borrow the money from my policy and I invest with the fund. That policy, this is huge. This is really important. That policy will continue to compound and grow on the entire $300,000, even though I've borrowed against the cash value to invest in said fund. Now, this allows my money to be doing 2 things at once. It's in my policy earning a modest, reasonable rate of return, cash-like equivalent return, and it's doing whatever the investment in the real world is doing. Now, to me, I cannot find anything else in the financial universe that does that. Now, I'm in control of repaying that loan on the terms that I specify. I can spend it or repay that loan over a year or 10 years or never. If I never pay off the loan, it would just be deducted from my death benefit when I pass away. So this becomes, in many of our clients' situations, a cash flow management machine. And it's where they keep all of their profits in between their investment opportunities. Think about that. As your investment, let's say your syndication deal does really well and it pays out a big profit, where am I going to put that money? I'm going to receive that money, and I got a couple options. I can put it in a taxable brokerage account, a taxable savings account. I can do a 1031 exchange and that's fine, but that inflates the problem of all that tax due someday. Or I could take that money and put some or all of it into my policy to just recycle to buy the next investment deal. So those are some ideas that might spur our conversation.
Gotcha. So, first thing that comes to mind, I spare no one on this show, Mark, and I'm not going to spare you either. When I hear life insurance, I think scam.
Who taught you to think that way?
I'm sure that a lot of people who are listening to this program. So you have an opportunity right now to change my mind.
Who taught you to think that? I'm just curious.
Well, I don't know that it was necessarily like any one person, right? There are certain companies, I think, that are, and I'm not going to name any names, right, that are associated with having that have bad reputations, and that is their primary, I would say, source of revenue, right, is selling life insurance. You talked about commissions just now, so I'm assuming, different rules apply to different people. I know fiduciary. So you said you're a fiduciary. Obviously, I understand like there's a lot of things that need to happen in order for you to get there, and there's so I understand like not every life insurance broker is the same, but the concept of life insurance as well has also like there's some questions as to how like legitimate some of those policies can really be. So you have an opportunity to change my mind though.
Sure. Well, I certainly, what's that old phrase? Those who are convinced against their will are of the same opinion still. So I certainly cannot change anything, not to mention something in between your ears. That's up to you. I will tell you this. I will tell you that. No, I'm saying that to me too, because I was just as skeptical, maybe more so. I was a Dave Ramsey fanboy all the way. I mean, I had the envelopes in my wallet and everything, and he's a hater of whole life. Now, you and I, before we hit record, we were talking about how there are a lot of real estate agents out there, right? That basically you can go to a weekend seminar maybe and get your real estate license. Well, the same is true with life insurance. Okay. I would like to say a few things. One, I'm not here to defend an entire industry. I don't think all whole life or any life insurance is for everyone a good idea, or two, every company that sells it is reputable. It's not. You shouldn't just, blindly jump into anything. Rental properties, life insurance, stocks, do your own due diligence, right? I will say that it's sort of like saying all cars are a scam. Now, is that true? Maybe some, especially in the early days in the Wild West of building, motor vehicles, there were plenty of scams out there. But let me ask you a question. I really want your answer on this, Danny, because it's something a lot of people ask. If it truly was a scam, how has it lasted for hundreds and hundreds and hundreds of years under strict regulatory guidelines at every state, local, and national level?
That's fair. That is fair.
Is that a clean slate for everyone? No. Do your due diligence, right? But working with a true competent professional like you are with real estate, or maybe I might consider myself as a fiduciary certified financial planner. And most importantly, this is something we haven't really talked about, the authorized program from Bank on Yourself. It's the only certification and authorization program in the industry that protects the consumer when they're buying these policies. Because I'll give you this, man. There are 400,000 life insurance agents in the United States. Okay, so just about as many real estate agents out there, So anybody with a couple of free weekends can get their life insurance license. And that does not mean they are ready to help you build what you and I just got done talking about. I've seen plenty of people buy into these whole life or, life insurance policies. They think it's whole life, but it ends up being something completely different. It's built for commissions. It's tied to variable markets. It's tied to, God forbid, an index universal life policy that can really wreck I consider that financial kryptonite for many people. So if it's designed properly, I would say you're safe if you buy it from a Bank on Yourself professional or someone who's been trained in the Bank on Yourself method. We can make those distinctions if you want. But buyer beware for sure. Don't just go out and buy the first whole life policy your cousin tries to sell you.
Okay, fair. Now, follow-up question to that. Can you explain the Bank on Yourself methodology? Right? Like what is that? What does that entail? Obviously, it sounds like we've already kind of maybe touched on it a little bit with being your own banker or whatever. But what does that mean?
Yeah. Well, what does it mean to be your own banker or bank on yourself?
No, what does it mean? What does Bank on Yourself mean? What is that? What is that method or methodology or whatever?
It refers to a concept that is both a practice and a strategy. So what do I mean? It's a practice in that you're not just a tennis ball floating down the gutter of life. You're banking on yourself. You're not relying on the government or some corporation to save you. You are taking your finances in and of yourself to say, what can I do to improve my family's situation today? And I love that, as a concept, right? But as far as a practice or you might say a strategy, it's using a particular asset class, something that many financial planners overlook. Yeah, we'll get you some cheap term insurance, then we'll go buy as much stock as we can. And by the way, the financial advisor will take a huge commission over 30 years. This is according to the Department of Labor, Danny. But a 1% fee on assets under management, which is stocks, bonds, mutual funds, the typical retail, amateur investment products that you buy on Wall Street, a 1% fee according to the Department of Labor over 35 years, which is typical for how long you keep your IRAs. 1% fee is going to eat up, gobble up, destroy, vaporize, whatever word you want to use, 27% of your life savings just due to fees. Now, if that's not a scam, please tell me what is, right? Because where's the guarantee on stocks, bonds, mutual funds, ETFs, target date funds, and more? Where's the guarantee? There is no guarantee in the Wall Street. The only guarantee of typical investment strategies like stocks, bonds, mutual funds, the only guarantee is that the financial advisor is going to get paid his or her fee, and that any gains you receive are going to be given to the government through taxes. That sounds like a scam to me. If you're really wanting me to, because I love the idea of this idea of scam is a good one. So, let's really dig into this. Which one has lasted for hundreds of years? The only two methods for wealth generation that I can find as a CFP is 1, real estate. Go back to the pyramids. And 2, contracts. In fact, real estate is only valuable because of the contract. Think about that for a minute. If I don't have a contract saying that I own that rental property across the street, then all I really have is squatter's rights, and whoever has the bigger shotgun is going to own that property. So it's the contract that really makes the difference in terms of ownership and wealth generation through real estate. Well, the same is true with life insurance contracts. A life insurance policy is a contract. That's all it is. It's just a contract. It's an obligation where you are pumping money into this project, this thing called a contract, and the insurance company is on the hook to pay you a guaranteed increase. So you're back to your, what does this thing do? Here it is in 4 simple sentences. Number 1, the insurance company is obligated to give you a guaranteed growth of your money every single year, regardless of market conditions. Okay. That's cool. Number 2, you can access the money tax-free if it's designed properly, anytime you want for whatever you want. Number 3, it is life insurance. So my family will automatically get more than I've ever put into that contract when I pass away. That's cool. And then number 4, I can bank on myself by borrowing against the policy and have that money continue to earn interest and dividends and growth as if I hadn't touched a dime of the money.
Okay.
So where does that fit into real estate? Well, could that be used as a line of credit for yourself? If banks stop lending, and they seem to like to do that as soon as the markets turn, right? When do we most need money? During a crisis, right?
Right.
When are banks least likely going to lend us money?
What, during a crisis?
During a crisis, yeah. And when are our real estate properties going to be worse off, right? When are they going to be valued at their least value during a crisis? So what if you had one of these policies where in the event of an emergency, a market downturn, you had guaranteed tax-free access to liquid capital that you could use for your real estate projects. Or even better, you could buy up your competitors' real estate projects. So anyway, we can get into the downsides. There's nothing perfect, but that's the concept, and that's why people use this strategy for real estate.
Understood. So a follow-up to that, because when I hear when I hear become your own bank, prior to our conversation, there are strategies, there are ways that I'm aware of outside of life insurance where you can also use personal assets essentially to be your own bank. For example, there are many financial institutions out there that will allow you to pledge assets, right? And so you can borrow against your assets. So effectively, what we're doing here with the life insurance,
that's exactly
now,
right. Yeah,
there's different rules, there's different all that good stuff, but effectively it's very similar. You could also do same thing with say like a home equity line of credit. You're doing a HELOC on your own personal residences, your own personal properties. You're taking a certain percentage out. Now, the argument that like you're saying, hey, what are the cool things about life insurance is that it still grows. Well, if I have my money tied up in a stocks, index fund, whatever, I'm pledging assets, it's still growing. Yeah. Same thing with the property.
Good
right?
observation.
So the property is still growing. So I just give you 2 examples there outside of life insurance. How do those differ, or what makes your strategy better than either of those 2?
Well, those are 2 great ones, and we can talk about the advantages and disadvantages. I'll even throw a third one on there. What about 401k loans? That would be another example where you could borrow against your 401k. Yeah. Yep. So let's tease each of these in time. Brokerage accounts, and you may be referring to margin loans or collateralized loans against other assets. Yeah. Like getting a business line of credit against your real estate. Well, what do we need to do there? First of all, we need to save up money or save up assets. Let's say you have $300,000 in assets. You walk into the bank. What happens next? You have to prove to them that you're worthy of their loan. How long does that take? How long does that take to get that loan? How long do you have to kiss the ring of the banker? And under whose terms are we getting this loan? Yours or the bank's? Who gets to decide when you repay that loan? You or the bank? What about the interest rate? What about if you can't repay the loan? What happens then? Okay, so you see where I'm going here? What if the underlying assets go down in value? When are we most likely going to need the money? Go back to the previous questions, right?
Sure.
When the assets drop in value, we're going through a recession or whatever, what banker is going to be willing to extend you that line of credit? I'll tell you a quick story. A business owner, he had $1 million line of credit collateralized against his equipment in his business. $1 million line of credit. He used it all the time for his business, to operate his business. The business got a phone call from the bank. Oh, by the way, this business had two full-time staffers, costing him about 80 to 90 grand a year to pay those two full-time staffers to run compliance for the bank. He had to have, people managing the paperwork for the bank. So this is an added expense on top of the interest rate he was paying to the loan at the local bank, right? Okay, so you get the picture. He gets that phone call from the bank, and the phone call I'm about to talk about, right? We're terming out your loan, Mr. Business Owner. You have 5 years to come up with $1 million. Yikes. What do you think he was feeling at that time? Well, not happy feelings. Okay. Maybe some words that wouldn't go so well on a family-friendly podcast were spoken. So anyway, he said, I'm never going to that bank ever again. He opened up a bank on yourself policy. He's got more than $1 million line of credit in there now. And he runs his entire business through his policy rather than through some bankster's idea of what he should or shouldn't do with his own money. Okay, so that's the first. You mentioned also home equity lines of credit. This is a great, I always talk to folks about this particular corollary because HELOCs are tied to a house. And a house, let's say your house is worth $300,000, okay?
Yep.
And you borrowed out $100,000 for a HELOC. Your home is still growing as if there was no HELOC. Some people are just blown away by the idea that the whole life policy could continue to capitalize and grow on the entire cash value like there was no loan. And they're like, Mark, that's too good to be true. That's crazy. And we just point them to the HELOC. The HELOC is a very common strategy where you can borrow against your asset as collateral and you still get the underlying assets growth. Zillow does not care if you have a HELOC or not. The house is still worth whatever it's going to be worth. Yeah.
Right.
So what's the downside to a HELOC? I'll let you give it a go here. What do you think? What are some of the gotchas with HELOCs?
Well, I would imagine, just going back to your previous example, you talked about like the bank terming out the loan. I would, a lot of those loan docs, you're not going to get something where like the bank could term out the loan, but variable rates are a big one with HELOCs for sure. It'll adjust. So for example, I have personal clients actually who when the rates adjusted, they were like, well, what do you mean my HELOC went from like 3% to like 8% in like literally a quarter, right?
Yeah.
So that's a big one. And I would say that's probably one of the biggest ones. And I'm assuming life insurance is going to be like a very stable interest rate, or maybe, I don't know what that looks like, right? But I would assume that that's probably like a big difference, right? Is a fixed rate versus a variable rate.
Well, we know that in 2008, they are callable too, aren't they? HELOCs can be called in a moment's notice when banks are in trouble. All of a sudden, it's not, you may be fine financially, but then the bank might be in trouble. Go back to last spring. What was it? Silicon Valley and some other banks went into trouble and, it may be the bank's problem and it quickly becomes your problem. There's no tax advantage to having a HELOC anymore either. So the terms that once again are set by the bank. You have to pay at least interest only. And then eventually they do term out that HELOC after a certain period of years. You have to pay that thing down. It becomes a regular mortgage for many people. And so you're right. Again, it all comes down to who is the one in control. I'll give you one more briefly with the 401k loan, because a lot of people think that's like free money. I honestly think it's probably one of the highest, most expensive ways to borrow money. Here's what I mean. You can borrow $50,000 from your 401k. All right. Maybe some people might do that to go invest in real estate. You can borrow up to $50,000 from your 401k or half the balance, whichever is lesser. Now I've borrowed that $50,000, let's say, and I've now got a payment to make back to my 401k. And Danny, you got, an after-tax repayment. So I'm repaying my 401k with after-tax dollars. It comes right out of my paycheck. I don't even get to decide it. The 401k is the one in control. So I'm paying $900 a month, let's say, back to my 401k loan, and that's with after-tax dollars. Fast forward now to retirement. So I've already paid taxes once on that $50,000 as I borrowed and paid it back with after-tax money. Now it's time to retire. And now I got to pull that 50 grand out again out of my 401k for groceries because I'm 62 years old or whatever. And now I got to pay taxes again on the same dollars. This is a way most people don't realize it, but it's one of the ways the government can tax you twice on the same dollar. I always say, don't use the 401k. It's the scourge of the middle class to use that 401k loan. No, bank on yourself policy loans are altogether different. Again, there's plenty of downsides, Danny, and I hope we have time to get into the gotchas and considerations. But when you borrow from a whole life policy, if it's designed the bank on yourself way, nobody asks you any questions. You don't have to kiss the ring of the banker. You could, you could borrow 300 grand and nobody knows what it's for. It's your choice, your private transaction. All this is done in the privacy of your own home. You can click a few buttons on your online site and you've got the money coming to your bank account within 4 or 5 business days. You get to set the terms of repayment. So you could wait until your syndication is full cycle, or you do that refinance or whatever, or sell the property and wait 3 or 5 years and pay off the loan in full at that point. Or you could set up monthly plan if you want to repay the loan monthly if you wish. Again, if you never repay the loan, it's just gonna get deducted from your giant death benefit when you pass away. Let's say that you had a $3 million death benefit, your loan was $1 million. Your family would get $3 million minus $1 million, so $2 million income tax free. Plus, they'd get all the real estate you bought with the loans.
Got it. Okay.
So we can keep going on this, but these are great questions, Danny. I can tell you're doing some deep dives on this. Were there any other? I can get into some of the gotchas or considerations, but I don't want folks to think I'm just out here pushing this idea. There are gotchas and downsides too.
Yeah, absolutely not. And I did come at you earlier because, that is, I think that people, when they hear that, their croc brain turns on and they're like, this guy is, we need to I'm turning off the episode immediately. Right. Which is why I wanted to ask that question when I did. Because I knew exactly what the majority of, I believe to be the majority of the people out there is like initial response.
Totally. I respect the question. And the reason why I answered the way I did was because so many of us are taught something without actually investigating it. Me too, by the way. Me 100%. Too. I had to have someone, they looked me right in the eye. It was a good friend of mine. He said, Mark, is it possible that Dave Ramsey could be wrong about something? And my mind just exploded right there on the floor, I didn't even think that maybe Dave Ramsey wrote the 5th gospel. I didn't know what, So at some point you have to really have that critical thinking. And I had to ask myself, who was it who was whispering into my brain to get me to think what I was thinking and at least to reevaluate and reexamine. So thank you for asking all the great questions so far.
100%. So as you were explaining everything just now, one thing that popped to mind is, and the reason that I love real estate, is due to the leverage. You can put $200,000 into $1 million property, and you're going to capture the benefit of the appreciation of $1 million asset. And so my thought is, okay, I put it into life insurance, right? Okay, dollar for dollar is what I'm getting there. Versus real estate, it's 20 cents on the dollar, right? I'm getting 5x the benefit, 5x the returns on my principal. On my initial investment. So that you kind of hinted there. So you started talking about it, and I might be answering my own question here, but you're like, okay, you can take that money, borrow against it, and then put it into real estate. So it's like you're double dipping, right? But I'm sure it's not like one for one, right? So actually, before we go into it, because I've got a lot of questions, why don't we just start there? Why life insurance when you can have so much more leverage when you're investing into real estate only?
Well, it's not an either or. It's not either or. Where is it written that you have to choose either real estate or life insurance? With most assets, it is either or. Either I buy, some real estate, or I buy some GameStop. Either I buy real estate or I get into crypto. It's an either or proposition. When you have a liquid contingency fund for any opportunity or emergency that comes your way. You're sitting on, again, let's use the number $300,000. Again, you could take a zero off of that, add a zero to that, right? But you got a big chunk of money. You could use that for the investment that gives you the leverage that you're looking for. In fact, that's what most of our clients do. I encourage them smartly, prudently, but to make smart decisions with their cash value. It shouldn't just be sitting there like a wet sponge. We should be accessing that money and putting it to work in smart ways so that they can do what they need it to do with their money. So if you've got 12% rate of return, if you've got 15% rate of return in a syndication, why not also get a modest middle single digit return, tax-free yield of, let's say, 5% in your whole life policy, in addition to the syndication? In fact, a lot of people, so that's 5 plus 12 in that case, right? So a lot of people see their whole life policy as a stop loss. What if the syndication, not yours, of course, but what if one of the investments goes to zero?
Yep.
That'd be terrible for, the guy that directly invested in that investment. But at least he had his underlying whole life policy still giving him that modest middle single digit return, right? So we call that the stop loss in this case. It still sucks because you got a policy loan you got to pay off.
Yeah.
But at least you have the underlying assets still earning and appreciating for you in the meantime.
Okay. Fair enough. And let's talk about cash value real quick then, right? So presumably you invest, let's just say $1 million into a life insurance policy. The cash value of that policy isn't going to be $1 million day one, right? So what does that typically look like? Just in terms of like percentages and I'm sure it probably fluctuates. It's not the same for everyone. It's not like
it does fluctuate depending on age and health and maybe more important than age or health, because you can be 85 years young and still get one of these policies. And you can have health issues and still get one of these policies. You can insure. I had a guy, he had a quadruple bypass 2 months before we met. He couldn't get life insurance on himself, but he insured his wife and his 3 adult children. He owns, with the grandkids too, he owns 12 policies on the family, even though he can't get life insurance. So to your question, the $1 million, let me kind of explain quickly. Again, everyone can start at their own amount. You could start with $100 a month. I'm working with a gentleman. He's putting in $1 million a year. We've got other folks putting in $3 million a year. So it can really range depending on how much you want to capitalize. Again, like a banker, you got to think like a banker. What banker wouldn't want to plow as much money into their vault as possible? So that why? Not just to swim in it like Scrooge McDuck, but so that he can loan it out to the customers who come in asking for loans, right? The more you got in your vault, the more you can loan out. The more I have in my policies, the more I can borrow. I, as the customer, can walk into my bank and borrow against it. To your question, yeah, there's going to be cost of insurance. And we talked earlier about considerations of this strategy. When you open a whole life policy or any kind of life insurance with cash value, there's going to be a insurance expense. It's just like when you buy a rental property, there's going to be closing costs and HVAC needs to be replaced and all that stuff. Similar, there's going to be expenses to buy the life insurance policy. How much? Kind of comes down to age and health again. But you might have somewhere between 70 and 95% of your deposit available in the first year, depending on how we design the policy. How do you get 95%? Well, there's a strategy called a single premium whole life policy where you dump in the money, literally just throw in $1 million. You'd have somewhere between 92 and 94, 95% of your money liquid within 30 days. So what is that? Is that possible for everybody? It may not be the right fit for everybody. Those are called modified endowment contracts. But other people, yeah, it's a great fit because that's super liquid. My theory and my philosophy is try to give somebody a place to park their profits for years to come. So Danny, you look like a pretty, you're about the same age where you may be a little younger. You're probably going to be very, successful, profitable, for years to come. Let's find a place to park that profit each and every year you have it. And a whole life policy gives you that tax-free parking space. When you get profits in your business, whatever it might be, real estate or whatever, money has to live somewhere. And to me, I can't find anywhere to put it where it's going to not get taxed every year. Savings accounts get taxed, CDs get taxed, and so forth. So this gives you a place to park that profit until you need it again to deploy in your next project.
So what are some of the tax benefits here? Because you keep talking about the tax benefits, but I am unaware of what you're talking about. So can you educate me and the audience?
Well, again, the government loves to incentivize, and incentivize us to do what they want us to do. The tax law is a series of incentives. It's a dance between us and the IRS. And since the Internal Revenue Code was established, which was way back in 1913, so 111 years ago, life insurance and real estate have both enjoyed considerable tax advantages. Why? Because the government doesn't want to be in the business of subsidized national housing. Thank God. I have seen what those look like. I don't want to live in that. And they also don't want to be in the business of taking care of orphans and widows alone. They certainly have welfare programs and more. But in order to take care of those who you leave behind, they set up a ton of tax incentives for life insurance that actually predate the IRS and predate the income tax. Remember, these policies, this contract it actually predates the U.S. Constitution. And so the life insurance favorability in the tax code has been grandfathered into the tax code and is still enjoyed today. So what are those? Well, I'll be brief, but again, there's tax deferred accumulation. So again, comparing it to a savings account, for example, if I put $1 million into my savings account, I'll earn a little bit of interest. Money market accounts, CDs, these are all the same. I'll earn some interest that year in my savings, and then they will tax me. I'll get a 1099 tax form on the interest I earned in a savings account or a CD. I don't get any of that tax nonsense on my life insurance. So the cash value grows with no tax due every year. That allows it to grow at a faster rate because I'm not getting hit on my growth every year. Does that make sense so far?
Yep.
And then there's tax-free access to the money. So there's very few things in the universe where I can grow it tax-deferred and have tax-free access. Those things don't go together very often. It's sort of like oil and water. So a Roth IRA comes to mind here. It grows tax-deferred, you might say, and then you can access it tax-free, but you got to wait until retirement to get the Roth IRA out of there. Life insurance, I can get the money out without taxes due when I'm 39 and a half or 89 and a half. I don't have to wait to some magical age when the government finally thinks I'm old enough to use my own money like in a Roth IRA. So there's tax-free access to the money anytime you want at any age, and maybe importantly for any purpose. So a Roth IRA has prohibited transactions. What do I mean? Well, you can't use your Roth IRA to go to the casino. You can't use your Roth IRA to buy a boat. You can't use your Roth IRA to go to college, get your kid to college. Life insurance, on the other hand, can be used for kids' college or for any of the other things I mentioned. And there's no taxes due to get that access to that money.
Don't give people ideas like that, man. Don't tell them to go to the casino.
Yeah, you're right. This is the only time you're going to hear a CFP tell folks to go to the casino. Yeah. Love it. Yeah, so those are a couple of the tax advantages. Then the income tax-free death benefit, that's a big deal. That's a big deal when everything else is, I think real estate's cool here because of the step up in basis. That's really cool. That's under scrutiny right now, you're probably aware. Under certain political parties and administrations, they've discussed taking away the step up in basis. But life insurance has had nobody even picking at the sides of this thing for, 100 plus years. It remains a vigilant, affluent place to park money. If folks want to just Google this, look up rich person's Roth IRA and you'll see what I'm talking about.
Interesting. Okay. Yeah, that's a lot of those things I was frankly unaware of. So that this is great for not just the audience, but also for me personally.
Cool.
We are coming up on time here, Mark. So there's a couple of last questions here for you, and I want to be respectful of your time. So you mentioned real estate financing through life insurance. Now, I'm assuming we've already is there anything else to cover when it comes to financing real estate other than what we've already talked about, which is like the using that as like maybe the down or maybe to even finance the entire real estate project?
Yeah, you can see it as a down payment purchase. You could use it for your property taxes. Those are annual, and any annual annoying expense, the HVAC that needs constant repair, the vacancies that cost you money, the property taxes, And all of those could be a lot of money if you've got a bunch of properties, right?
Yeah.
So why would I spend cash dollars that I'll never see grow for me ever again to buy my taxes? I'd rather recycle that money in and out of my policy over and over again. We've got whole webinars on that on our YouTube channel or on our podcast, where you can talk about how you can use this for major annual expenses like property taxes or kids' college tuition or anything else. And then ultimately I'm sorry, go ahead.
I was just going to say all of those the two things that you just mentioned there will be linked in the description below. So
sure. Sounds great. Thank you. I'm happy to get those to you. And ultimately these all become all whole life policies become a bucket of money from which you can draw on for tax-free income in retirement. So maybe you've got 8 or 9 rental properties. Maybe you've taken all the depreciation you can off of those rental properties. Maybe they're now still paying rent. Hopefully you're still charging rent on those rental properties. And now you're 68 years old and all the depreciation is gone. And that rental income is all hitting you like a tax freight train every year, right? You see the concern here. A lot of our real estate retirees have a problem of too much rent coming at them and it's hitting their taxes and they're getting thrown into a higher tax bracket.
Yeah.
Life insurance can offset that by taking that money out of the life insurance. It's income tax free. It doesn't even get reported to your Social Security or Medicare premiums. And so you can donate your rent money if you don't need it or give it to the grandkids or keep it in a savings or 1031 it. All sorts of strategies, man. There's more than we have time for.
It's very interesting. I want to end with this question. We talk about private family banking, and you've discussed on other episodes how families can set up their own banking system. Is this just a web of life insurance policies, or is there more complexity to it?
At the end of the day, no, it's as simple as that. A web of policy, ensuring grandma, grandpa, adult children, grandchildren, everyone buying the next generation with their premiums, the whole family contributing. But there are so many creative ways to do this, man. Like we've got a family that meets together every Thanksgiving. They travel from across the U.S. They're at a ski resort. They're having a fun dinner. And they're talking about all the ways they're using their policies. They're lending money to Johnny for his new business. They're getting a loan repayment from Susie for her college tuition. The whole family has extricated itself. Is that a word? Extricated itself from the banking system and has brought the banking function back in-house. And maybe most importantly, they're teaching the children. They're not just preparing a big pile of money for the kids. They're getting the kids ready for the money, which is such a good thing, building those values right in.
Yeah, that's interesting. That's really interesting, Mark. And I think that if anything, you've helped at least open my mind up to the possibility of doing something like that. And for anyone who's listening to this episode, you can get in touch with Mark. We're going to link all of his contact information and how to get a hold of you in the show notes and in the description. But Mark, this has been awesome, man. And in traditional Gould Mine fashion, I want you to leave the audience with one final Gould nugget. Take it away.
Okay. I'm going to get today's quote because I found this today in my reading and I just thought it was cool. It's in Latin though, so I got to go look it up really quick. And I don't really read Latin, so forgive me. But si vis pacem para bellum. If you want peace, prepare for war. If you want peace, prepare for war. It's a great reminder that when do you prepare for the hurricanes? When do you prepare for the tornadoes? It's when the sun is shining, right? You can do that with Danny and with the real estate work he does. I'd be honored to work with folks if they are interested in learning more about this. The best way to reach us is kickstartwithmark.com. And we'd happily do a 15-minute phone strategy session and imagine together exactly how we could bring the banking function back into your life. That's kickstartwithmark.com.
Love it. That's easy to remember. Great job on getting a good domain name there, dude.
Appreciate it. We do what we can.
Love it. Mark, this has been awesome. Thanks so much. And who knows, this might not be the last time I have you on. There's so much, dude. There's so much. I have like pages of notes that I didn't even get to.
You do a great job. Mm-hmm.
So I am sure that we'll find another time to have you on and kind of continue the conversation because I think we only really scratched the surface here.
Very good. Love to have a chance to be back on again and share some more. Love to talk.
Awesome.
Thank you.
Love it.